Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra. The Nifty is now trading below the 24,500 mark. So there is some give back after 4 days of gains. Down close to about 100 points in the Nifty. Sensex down 300 points. The mid-cap index, again, off from the session highs, but so far in the green. And this would mark the 7th day that the mid-cap index has a positive uptick. So far this week, it's gained close to about 3% Sectorally, IT is holding forth. The Nifty IT index is up more than 0.5% on the way down. You've got cuts in banks. The Nifty banking index is down. CPSC index is heading towards a 1% fall. But in the broader markets, these platform companies, new age tech companies, Swiggy, Zomato, Ola Electric, they continue to see a lot of action.
Oh, yes, and that was the case that we saw yesterday and day before yesterday as well, right? Swiggy, after reporting its numbers and the conversation that we had with the management as well, Zomato on the back of that as well has been surging off late. And as Reema pointed out, Ola Electric doing. A lot of these actually the new listings, they continue to do well. Niva Bupa, for instance, is also one stock which is continuously going higher. You have the pharma space which is not doing so well. So 0.8% lower on that one. We have the energy space as well, along with the CPSC basket, which does not look so good today. But the small cap outperformance continues. So that's where we are seeing a gain of around 0.5%. So that will continue to be in focus and on our radar as well. But one sector that continues to be in focus is the city gas space. It is in focus. Government sources tell CNBC-TV18 that they do not see a rollback of APM gas allocation cut to CGDs. Sapna is joining in with more details on this one. Sapna, what are you picking up? Okay, all right. So we'll get back to Sapna in just a bit. The stocks have been holding well. Yesterday as well, IGL and MGL both were up anywhere between 4 to 5%. After that massive cut that we saw in stock prices as well, there is some comeback that we have seen. IGL is up around 1.6%. Mahanagar Gas is up around 1.2%. And those important flashes that are there for at the bottom of your screen, which are coming in from Sapna, that government will not roll back the APM gas cut allocation that we saw earlier. So we'll get Sapna in just a bit. But Divi's Labs is the other stock on our radar. It is under pressure after Novartis loses an appeal in a US court for a key hard drug for which Divi's is a key API supplier. What does it mean for the company? Vinny is joining us with more details.
So absolutely. So this was an important case that was going on for a while. Now Novartis has not managed to convince the US District Court about this. And Novartis is an innovator. It was up against MSN. So MSN won the case for this Entresto drug, which is a drug which is got a lot of generic players as well. So now this ruling in favor of MSN means that there are other generic players that could also come in the pipeline for launches as well. So for DVS, because it is a supplier for Novartis for this drug, it does impact them in terms of overall their EBITDA as well as a bit in terms of the volumes of DVs that could be impacted as well. Now previously we had some analysts that had highlighted in terms of this case as well. They said that this drug contributes around 12.5% for FY25 in terms of EBITDA for DVs. So keep an eye out on that. And this generic entries of other players could lead to 10% downside in terms of FY26 and FY27 EPS also. So a bit of a risk coming in for DVs on that front, and that is why we're seeing the stock is falling in trade today.
Thank you very much for that. Let's talk about Bajaj Auto, because despite the clarification coming in from the management about the repricing of the base variant of the Freedom bike, the news which came yesterday that they are cutting the bike prices by about 5,000 to 10,000 rupees for the Freedom 125cc. The stock slumped yesterday and today down another 2%. So no respite there. Sudarshan is here with more details. Sudarshan, what did the management have to say?
So stock is under pressure despite company's clarification regarding the price cut. UBS had yesterday put out the note saying that company has taken price cut for select variants of Pulsar and Freedom 125 bike. Now company has clarified, speaking to CNBC-TV18, company says that it has 3 variants in Freedom 125 bike, and top-end variant that contributes almost 72% of total sales, and price when the company had launched this product, price was rupees 1.10 lakh, and still the price remains the same. So there is no change in the price of top-end variant, which forms 72% of total sales. Price change in the base variant. which has been reduced to 90,000 from rupees 95,000. Another variant is the mid-level variant. Company says that during the launch, the mid-level variant which was launched, now the mid-level variant, it's not the same. So it's the new mid-level variant that company has brought into the market, and for that the price is rupees 95,000. So it's not be taken that mid-level variant during the launch, for which company had put the price of almost rupees 1 lakh. The price has not been revised for the mid-level variant. So two variants, there is no change in the price. Only price change is for the base level variant. And regarding the total build units, company says since the start of the production, it has built 66,792 units of Freedom 125 till November of 30th. Now it has retailed almost 40,000 units in the same period, and it has stock of 27,000 units, which as per the norm is normal. So there is not a concern on this front as well.
Okay, all right, we get that point. Thank you so much for joining in with all those details, Sudarshan. Let's get back to Sapna now. She's here to tell us what sources are suggesting on city gas companies. Sapna.
Well, yeah, hi, morning. So basically, the indication is that any kind of rollback is unlikely. I do not think that there is any such proposal, officially, so to speak. The sense that we have been given is that, basically companies should be doing they should pull up their stocks and do some intelligent sourcing. In the sense, try to tap the long-term energy contract market more. I think that's where we have been kind of lacking. Of course, the other option is sourcing the supplies from the new wells. The basic fact of the matter also is that, overall natural gas production has been coming down, particularly the APM gas from the old wells. Around 8 to 10 odd % decline has been witnessed over the last couple of years, and probably this trend is unlikely to change, at least as of now. So keeping all of this in mind, companies should be looking at other options rather than just trying to depend on the APM supply. That's one aspect. Second, we have also been given to understand that probably for the last 2 odd years, the way the production has declined, not all of that had been shared. Not all of that has been kind of passed on to the CGDs. So, 2 consecutive gas allocation cuts back to back this year that we have witnessed probably are also fallout of the fact that, the attacking has not been passed on. This is what has happened right now. This is the situation as of now.
Got it. Thank you so much, Sapna, for joining us with all those important details. The stocks, of course, are not reacting right now. But do remember, if they do have to look at other sources of gas sourcing, it would be more expensive. Currently, they get it at $6.50 per MMBTU if they are sourcing it from domestic gas allocation. But the other sources would be $2 to $3 higher. LNG prices in some cases go up to $11 to $12 per MMBTU. So we'll have to figure out how these companies would go ahead and change their sourcing and how that would impact their volumes and margins as well. We'll slip into a short break for now. Manisha joins us on the other side to discuss the price of Bitcoin. That has hit a record high, so we'll discuss that.
Welcome back. It's absolutely extraordinary what's happening with Bitcoin. It's a new milestone, a new record high on Bitcoin crossing that $100,000 mark. Manisha is here with the details. Manisha.
Oh, well, absolutely. 100,000 was a level that, the markets have been anticipating for almost a month, and we finally have seen that come in. Interestingly, the volumes with the surge also have been quite on the stronger side. So we're looking at a record $2 trillion of a market cap for Bitcoin. And if you look at the Bitcoin prices, we've gained up by 144% in this year until now. Well, importantly, when you look at the overall market cap as well, that also is at a record 3.89 trillion right now. So we're making records across when it comes to cryptocurrencies there. Well, when you look at this year, it has been quite on the stronger side. The latest support clearly comes in from the fact that the US President-elect Trump has actually named a cryptocurrency advocate, Paul Atkins, as a SEC chair. This is after Gary Gensler has said that he would step down in the month of January there. So this is seen as quite positive because there are various rules and regulations and clauses, etc., which could come in on a friendly way in case of cryptocurrencies, and that is where the sentiment really seems to be coming in from. The other thing is the US-based spot ETFs. Remember, these were launched in the month of January in 2024, and in less than a year, we've seen $30 billion flying into this product. So even as you're looking at these markets, you have seen institutions buy, retail has been holding, there have been corporates and companies and mutual funds as well adding cryptocurrencies into their portfolios and for their clients as well, taking these prices on the higher side. The other thing clearly comes in from Russia, where the President Putin says that nobody has the power to ban cryptocurrencies. Actually, it was in the last week itself that Putin has signed a law classifying digital currencies as a form of property in foreign trade settlement. I mean, at this point in time, this is being done as a trial, but the way things really seem to be going, with various countries now talking about pushing into digital currencies, actually taking it into as a forex reserve as well, you perhaps are looking at just about a start when it comes to run up in this space.
Okay, all right. So 144% surge in the year so far. Thank you, Manisha, for joining us. We'll see what happens by the end of the year. We are very close to that as well. But it's time for a short break. Amit Dixit from ICICI Securities joins us next to discuss the defense sector after Centre has approved 5 proposals worth nearly 22,000 crore rupees. Welcome back. You're still tuned into Trading Hour. Well, DSC, the Defence Council, has approved 5 acquisition proposals worth 21,772 crores. To understand what the opportunity is and what it would mean for the listed space, we are now joined by Amit Dixit, analyst at ICICI Securities. Amit, good morning. Thank you so much for joining in. Well, as per the release, it's still an AON, right? The acceptance of necessity. Can you give us a sense of, after this AON, how long does it take for these orders to get converted into final orders? Then how long does it take for execution? Which are the companies which would be impacted by this?
Yeah, hi. Good morning, and thanks for having me on the show. So from AON to ordering, you can expect at least 2 years. There has been cases where after AON things are pending, but generally, I mean, by thumb rule, by DAP 20 policy, it should be around 2 years. So that is the time frame we are looking at. And looking at the companies that are going to be benefited very clearly, almost half of this proposal is directed towards the naval support fleet, I would say, the smaller vessels. So the smaller vessels are manufactured by GRSC, by Hindustan Shipyard, L&T, Goa Shipyard. So these are the shipyards that could get benefited. Some of them are listed, some of them are unlisted, of course. Now, the overall benefit for shipyards, in my view, could be a little bit lower because it is going to be a competitive bid. Now, another proposal that is there for the EW system, including jammer pods and radar system for Sukhoi. I think BEL and Astra Microwave in the listed space would be benefited. Of course, HAL directly gets the benefit of the overhaul of Sukhoi 30, and then there are various other overhauls of T-72, T-90 tanks, including BMPs, for which ordnance factory boards would be benefited. However, having said that, in all these cases, if you look at the overhauls, if you look at the other work, I think BEL is involved at all the places, and therefore BEL is likely to get the trickle-down benefit of all of these. Astra Microwave, particularly, I think from jammer pods of Sukhoi, it should get the benefit, and so as other radar players. From the engine part, what we see that some of the companies who have actually built in their own infrastructure for producing metal stroke components like PTC Industries might get benefited from this engine overall in a long run. Now, execution, once the order is given, typically takes 12 to 18 months for mobilization. So we could see the first rupee of revenue from this actually 3.5 years from now.
Amit, is it possible to break up the proposals which are worth about 21,700 crore rupees? You said, so BEL will be able to participate in what, 15,000 worth of orders of this amount, 20,000 worth? And if you could give that for all the companies. So for instance, Garden Reach, they may not win it, but at least in terms of the opportunity, is it possible to break up the individual companies?
No, so actually the press release of Defence Council doesn't break it up. However, as per our estimates, as per the past precedent. We believe that the opportunities in the vessels, that is the shipping, the AONs, two of them, could be to the tune of 9,000 to 10,000 odd crores. And this is the opportunity for all the shipbuilders. It may be L1, L2, because considering the number of boats that are there, 31 and 120. So this definitely would be split. However, yeah, this is the opportunity size available. Now, within that, typically we have seen that the electrical equipment, radar, etc., in these smaller vessels could be to the tune of 20 to 25%. So that benefit would come to BEL, even from that 9 to 10,000 crores kitty. Now, talking about the radar and EW part, so I think the total quantum of that could be to the tune of roughly 3,000 to 4,000 odd crores, and it directly goes to BL. From there, it can go to Astra Microwave, can get some part of it. Data Patterns can get some part of it. Some other companies can get part of it. Similarly, for the overall packages, the overall quantum could be to the tune of around 3,000 odd crores, 2,500 to 3,000 odd crores. And largely, Ordnance Factory Board will benefit. But again, out of that, 25% almost would be electrical system, fire control system. For that, BL could be the one that would be benefited. And then from the 6 numbers ALH, of course, that is to the tune of around 1,400 to 1,600 crores. That directly goes to HAL. And again, within that, the electronic component, to the extent it is indigenized, those benefits come to BL directly. So as I said, BL seems to be the largest beneficiary in this kitty.
Got it. So, Amit, these are some of the beneficiaries that you spoke about, and of course, it'll take some time for it to get converted into final orders as well. But till then, how do you look at the defense stocks right now when it comes to valuations? They have corrected from the top. Do you think this could be a trigger, because this order is smaller than what we have seen earlier, right? But it has come in after a long time, 3 months almost. So, what is the valuation picture looking like in the defense space?
Yeah, so one thing is very clear, that this AON is one of the smaller ones that we have seen in the recent time. The last AON that came in September was quite humongous, 1.4 trillion, to be honest. This one is like almost 217 billion. So it pales in comparison to that one. Having said that, there are AONs last year. If you look at FY23, FY24, we have got around 2.6 trillion to 3.6 trillion respectively of AONs last year. And these would be coming for ordering, as we go ahead. So execution should pick up. Now, having said that, we are in fact positive on the names that have more of exports in their kitty, because one of the government's directive is to promote exports, and there are companies like Solar Industries, for instance, who have got a very good export order book in their overall portfolio, and that is also of shorter duration. So the revenue recognition could be a lot faster in some of these companies. Now, having said that, among DPSUs, BEL remains our top pick, mainly because of the fact that a lot of the execution parts are kind of ironed out because of its presence across the platforms.
Okay, all right. Amit, thank you so much for joining in today with those details and the analysis of what it could mean for the entire defense space, and individually which companies could benefit from this AON. Let's slip into a break. When we come back, we'll discuss market technicals with Vishal Malkan and also discuss the top trading bets.
Welcome back. It's in the red now for all the indices. So the Nifty was anyway down about 100 odd points, now down 130 points. But the mid-cap index, which was marginally up in the green, has now dipped into the red. Vishal Malkan is now with us on the show. Vishal, morning, and thanks for joining in. Is this just routine profit booking because the last couple of days have been good for our markets? And what will the stock calls be?
Yes, I think this is kind of a profit booking after a good rally we have seen in the last couple of weeks, especially Nifty and Bank Nifty both. So I can look at further downside of Nifty around 24,300, 350 as another 100, 150 points, and Bank Nifty around 52,800. So the stocks which I would like to buy on this dips, one of them would be Voltas, which is around 1660 right now. So I'll go with a stop of 1650 for targets of 1690 and 1720. And the second one would be PSU Bank, which is PNB. With a stop of 107, I will go with a target of 113 and 117.
Okay. All right, Vishal, thank you so much for joining in today with your technical bets and picks. With that, we'll slip into a short break. When we come back, we'll discuss market fundamentals with Sahil Kapoor from DSP Mutual Fund. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. It's time to discuss some market fundamentals. Sahil Kapoor from DSP Mutual Fund is joining in now. And in their December report, there is an interesting section which talks about why India outperforms over the longer term. Sahil, good morning. Thank you so much for joining in. I just wanted to understand that because so far in last couple of trading sessions, we talk about this big retail inflow. And maybe that is what is keeping the markets afloat despite FII outflows. What, according to you, are some of the major reasons that you attribute to this long-term outperformance that we've seen?
I think flows and probably GDP growth are two of the most simplistic reasons that we attribute to India's outperformance. But institutional flows in totality have been very consistent. They haven't been up or down if you add up all institutions. But I think the broader reason why India has done well has got to do with the quality of businesses we have. So we looked at data across the world. And we looked at, let's say, United States, India, emerging markets, China, etc. When you look at, let's say, US, 39% of companies have delivered an ROE of 20% or more over the last 20 years. India stands at the second place with nearly 1/3 of all companies in India delivering a consistent ROE of 20% or more. Now, this is very rare when you look at the emerging market basket as a whole and you adjust for cost of capital because most countries have a different cost of capital. India again stands at the second spot, just behind United States. If you remove, let's say, the top FANG companies of United States, India will actually get to spot number 1. So first is, even adjusted for cost of capital, Indian businesses have delivered very high shareholder value when you measure it by ROE. And when you look at, let's say, emerging market as a pack, it has actually detracted shareholder value. It has delivered negative value to shareholders. So this is one of the chief reasons why India has done well. Second, of course, is the consistency of how this has happened. So when you look at the NSE 500 universe, there are about 50 companies, 49 to be precise, which have grown their book value, which could be one reason, not the intrinsic value, every single year over the last 20 years. And there are, for example, there are only 2 or 3 banks globally which have reported a rise in book value every single year over the last 30 years, and 2 of them are Indian banks. So these are very, very rare numbers. They are not available across the world. And third, possibly one of the reasons when you look at global leaders in the top 14 sectors we looked at, for example, banking, aerospace, oil and gas, etc. We looked at 14 sectors. In 10 of these 14 sectors, Indian business leaders have a higher return on equity versus the global leader. So, and second, if you look at the earnings per share growth over the last 20 years, 12 out of these 14 sectors, India is ahead in terms of earnings per share growth. So I think these are some of the very, very important nuances which are more bottom up, which allows investors to identify good companies and probably ride them over time. Other parameters, for example, a stable GDP growth, of course, that is one of the factors, but it is, I think, only an enabler. When you look at it from a longer term perspective, there are many countries which have, for example, China, done much better in terms of real GDP growth rate, but the businesses there have fared much worse. And there is another country, for example, Brazil, where GDP growth has been dismal at about 2.5%. but their dollar returns have been much higher than India. So I think all these narratives of flows or probably of growth can be easily falsifiable if you just look at a few data points. So at the core of outperformance, I think stands the quality of Indian businesses.
So that positions us very well for long-term returns in equity markets. And historically, equity has always done better than debt. But there have always been cycles, even in this uptrend, where debt has done better than equity. So if just someone looks at it, there is a 1-year cycle, 2-year cycle. So for the next year, 2025, what's the outlook on equities per se? Just again, 1-year view on equity versus the other asset classes like debt, gold. And while continuing your SIP, should also one be looking at, these other asset classes which could, just in the near term, give you better returns?
No. So 1-year outlook most likely is going to be random. I have no clue what will happen in the next 1 year. But one thing is very clear: Indian markets are trading at a very, very expensive valuation in some pockets. There are pockets where there is probably attractiveness, but as a whole, we are in, let's say, in a rich zone in terms of valuation. And the same report talks about where we are in that whole bucket. So when you look at these numbers in totality, and let's say you look at a number called let's say Nifty's price to earnings ratio versus the peak EPS, which is the highest earnings that we achieved. Currently, we stand at a place which is close to the peak of, let's say, 2008 or 2017 December cycle. So our valuations are not very attractive on the whole, which means that probably the recent returns may not get replicated in the future, in the near future. And to your second point, should we continue our SIP? I think if we can continue our SIPs for, let's say, infinite period or perpetuity, there is no reason to listen to any of these views, including mine. You are accepting, longer term average returns, which probably should be better. As I said, quality of businesses is good. And most businesses, some of them, if they come into a portfolio, will deliver returns which are higher than bond markets, right? So for any SIP investors, the idea is to continue their SIP forever, irrespective of where the market is or where the valuations are.
Get that point. Sahil, then let's just talk about the different market cap universes, right? We've been speaking about how, and your report suggests that large cap stocks are the smallest share of market capitalization. Then how does one go about investing in, say, small caps versus large caps currently? You think large cap outperformance, which was expected to happen in 2024, is a theme that could work in 2025?
It could, of course. I think when you look at the numbers, and if you are a believer in mean reversion, then possibly there is a place and idea to put money in, let's say, large cap in terms of relative allocation. From a small and mid cap perspective, I think we'll have to be extremely focused on quality because there are pockets within this small and mid cap space which have become expensive. And historically, we've seen that there are long periods where they don't deliver returns. For example, a period like 2008 to and then 2016, there were hardly any returns in small and mid-cap stocks because you had a stellar rally before that. So usually, high recent returns are followed by low returns eventually. And currently, we have a mix of high recent returns and also high valuations. So I will probably adopt a staggered investing approach in small and mid-caps. In the last question we asked about SIP, if you are a SIP investors, you should continue just doing that. But if you're putting a new absolute rupee into the market today and probably looking at equity as an asset class, then I will lean towards allocating more to large caps. This does not mean that large caps on an absolute basis are cheaper, right? They are also trading at, as I said earlier, at rich valuations. They are not cheap, but on a relative basis, I think they will hit the value zone much earlier than mid and small cap. If a correction occurs. And as you said, currently, let's say the top 10 stocks compared to the total market capitalization have a share of only 20% in terms of overall market cap, which is, I think, an all-time low. If you go back to data 30, 40 years also, you will not find this data occurring anytime in the past. And there are many reasons why this has happened. One of the reasons is that small and mid caps have done extremely well. And second reason is there has been a huge amount of paper which have been raised, equity issuances, and the average listing, let's say price to earnings multiple for a large number of these issues is more than 70 times. So which has taken a huge market cap to this universe and made the top 10 or even the top 50 stocks, much more cheaper on a relative basis. So I think that is the reason why you should look at large caps.
Thank you. Thank you, Sahil, for joining in and giving us all those data points. Great conversation. Get into a break. On the other side, we'll tell you the key expectations from the RBI monetary policy slated tomorrow. Welcome back. Now, the big event is the RBI monetary policy tomorrow after the lower than expected GDP print. Ritu's here with the key expectations. Ritu.
Well, the sharp slowdown in growth has put RBI in a very uncomfortable position. There is growing chorus for a rate cut, including from government officials, at a time when high inflation, which has now breached RBI's tolerance threshold, continues to be a spot of bother. Now, our poll shows that 7 out of 10 economists do not expect the lower than expected GDP print to accelerate the rate cut cycle. They believe the primacy of inflation will prevail. Now, the MPC is expected to leave the repo rate unchanged for the 11th consecutive policy because of, lingering inflation concerns and also the volatility in global markets. And instead of going for a rate cut, the governor could address the growth concerns with a dovish commentary, laying the foundation for a potential rate cut in the next meeting. In fact, an overwhelming 90% respondents said they expect to see the first rate cut from the MPC in the February meeting. The total quantum of cuts in the entire cycle could range between 50 to 75 basis points. Now, while a rate cut is ruled out with inflation above 6%, there could be an explicit acknowledgement that growth needs support, and as a step towards eventual easing, the RBI may instead go for a cash reserve ratio cut. But here again, the economists are pretty divided on the possibility of this happening, with only 50% seeing the chance of a cut, which could ease some pressure on the banking system liquidity. Now, the GDP forecast is also likely to grab a lot of attention. 70% of our respondents predict that RBI could lower its FY25 growth forecast to 6.4 to 6.7%, while 20% foresee a revision all the way down to 6 to 6.3%. On inflation, half expect the MPC to revise the current year's projection upwards to 4.8 to 4.9% given the concerns around food inflation, while 40% expect a more modest increase. Now, apart from the policy decision, the RBI statement is also expected to focus on liquidity management, and our respondents expect that RBI will continue managing liquidity through both main and fine-tuning operations as necessary.
Okay, that will be the big event to track tomorrow, and you can tune into CNBC-TV18 for the analysis. But for the markets, if we take a look, it's a cut of around 110 points on the Nifty. There was a sharp fall when we started the show. There was some recovery from those levels as well. But for now, it's a cut that we are looking at. The Bank Nifty is the one which is contributing to the cuts that we are seeing as well. And if we talk about sectoral movers...
I think we have the CAA, V. Anant Nageswaran, speaking right now at the ASSOCHAM Summit. Let's cut across.
Cold storage and food processing, etc., we can look at a sustained 5% growth in agriculture, which, given its share of GDP of between 15 to 20%, that contributes about 3/4 to 1% of GDP. So there is still much room to extract greater value addition from agriculture. It is not a sector of the past. It can still be a sector of the future because climate change is going to make food security an important priority for many nations. And given our size and landmass that we have, if we can boost agricultural productivity, that can actually be a bigger source of exports along with the services sector. So these are the points, and we have actually a special box item in Chapter 5 of the Economic Survey published in July, which identifies some of the key things that we need to do to be able to make agriculture actually a sector of the future rather than something belonging to the past.
Thank you so much. Come and have a seat. Thank you. Really, this was fantastic. Thank you so much.
Okay, that's the word coming in from the CEA. We're going to take your leave now on Trading Hour. Don't go anywhere because after this short break is Halftime Report.